Here are my top 8 stocks to buy right now, half of which are stocks that I actually own in my personal portfolio, and half of which are new stocks that I've never talked about before on this channel. And we'll be alternating one stock that I own, followed by one stock that I don't own, and working our way up until we talk about the largest single investment that I hold in my portfolio. Hopefully you'll find a new investment that you can use as a starting point for your research. And at the very end, I'll show a pie chart of my actual stock portfolio showing you every single stock that I invest in. So make sure to stick around to see that. So let's kick it off by showing my actual stock portfolio and walking through how my investments have done this year. So if we look back over the last 3 months, my portfolio is up $30,000 during that time, which is around 24%. And if we zoom out a little bit, we can see that there's been some pretty big swings in my portfolio. Back at the end of March and heading into April, we saw a drop from 130 all the way down to 123,000. Then we saw it rise again before dropping to an all-time low of 117 before steadily rising throughout the rest of the year up until now. Part of this is because investing in individual stocks is risky, and part of it is because I'm heavily invested in high growth technology stocks, which tend to be even more volatile. But the higher the risk, the higher the potential reward. So the first stock that we're going to talk about today is Nubank, which is a stock that was originally brought to my attention by Future Investing when I was on his podcast. Nubank is a company that plans to take Brazil from a country that has lagged Western Europe and the United States and bring it ahead of those countries in terms of their financial infrastructure, much like China did in the 2010s. But to understand Nubank, we first need to understand their economic markets. See, the government of Brazil has 3 councils that influence the economy. The National Monetary Council is in charge of promoting economic and social progress in the country. Then under Brazil's central bank and the Securities Commission, we have the area where financial operators like Nubank operate. Nubank is currently experiencing what can only be described as explosive growth, growing revenue 87% year over year while increasing their customer base 33% to 80 million people in this quarter, which is now equivalent to 46% of the entire adult population of Brazil. And we can clearly see that growth starting to show up in their stock price over the last year, with even investors like Warren Buffett investing in the company. From what I understand about this company, which admittedly I'm still learning about, the big bet here is basically betting on the future of Brazil's economy, and that they'll become an economic powerhouse similar to the way we've seen other countries around the world develop economically, creating billionaires and hordes of millionaires as they've developed. And we can see Brazil starting to back Nubank pretty strongly as their largest fintech. In 2020, Brazil launched open banking to allow banks to share customers' data with fintechs if customers consent. And it's been part of an even larger push for financial innovation in the country. This puts Nubank in a really strong position where they're basically head of the financial markets in Brazil, and they have a strong push by a developing world power behind them. They also have the potential to expand into other Latin American markets next, like Mexico. But it's still pretty early days to see how successful they'll be there. Anyone who's followed my channel for a while might remember C Limited, which is a stock I used to cover, and that company attempted to expand their fintech market outside of Southeast Asia and into Latin America. But they saw somewhat limited success, and we didn't see their growth rate continue once they saturated their home market. Next up, we'll be getting into the first stock that I own. And remember, stick around until the end to see the full list of stocks in my portfolio. And if you appreciate the transparency, maybe consider subscribing and helping us hit our goal of getting 50,000 subscribers by the end of the year. So the first stock I own is SoFi, which I currently own 1,900 shares of at a value of $16,000, which is up around $4,000 off of my initial $12,000 investment. Now, SoFi is a fintech company. They're kind of like 3 businesses in one. You have their lending business, their financial services business, and their technology platform. Their lending business is where they make most of their money, and this has been impacted strongly by the student loan moratorium of the last few years. As that is potentially ending soon, that could have a big impact on their stock price in the short term. Next, you have financial services, which includes things like the SoFi app. This is an area where SoFi has been seeing the most rapid growth, and they're starting to achieve variable profitability in this area. So right now, they basically spend a lot of money to acquire customers here and hope they make up for it at the lending business. But as we go forward, this business could be profitable in and of itself, which means SoFi's growth is only going to accelerate from here. Lastly, we have their technology platform, which is more of a longer term bet. Their technology platform is basically the infrastructure that underlies all of SoFi as a company. And up until now, they've been using that platform to make their services cheaper and more competitive than their competitors. But going forward, they plan to build the AWS of fintechs, meaning other fintech companies are going to run their entire businesses on SoFi's underlying platform, meaning SoFi will be able to innovate and create new features faster than anyone else, and they'll get paid for the right to do so. This is one of the reasons that Amazon blew up into such a big company in the first place, was a very similar approach with their AWS. Now, SoFi has seen a rapid growth in their stock price over the last 6 months. They've gone from as low as $4.50 a share to currently $8.42 a share as I'm filming this video. So there may still be some rocket rockiness ahead, but I would expect their stock price to still have quite a bit of room to grow from here and probably at least be able to double. That being said, I'm a long-term investor who looks out for a 5+ year time horizon, so if you're a shorter-term investor, this might be more risky for you. The next company, which I do not currently own, is GBLE, which is an international sales company based out of Brazil. Their whole goal is to focus on international sales. So if you think of traditional sales and marketing, it tends to be very region-specific. What works well in, say, the Eastern US might not work as well in Southeast Asia. But with more and more companies becoming globalized and spread across multiple different countries, GBLE allows them to expand outside of their native country and into other countries around the globe. One of their biggest customers is Shopify, which is an $80 billion company that has GBLE integrated into their platform. One big name investor in GBLE is Cathie Wood of ARK Investing, which, depending on who you are, is either a good thing or a really bad thing. But the reason she's investing is mainly due to their growth story. GBLE is currently around a $6 billion company. But if we look at their growth rate over the past year, they grew 67% in terms of their total revenue in 2022, with many of their clients going live across multiple different geographies. And perhaps even more importantly than their revenue increasing is the fact that their non-GAAP gross profit increased at 77% year over year. So not only is the company bringing in more money each year, they're bringing it in a more profitable way as their margins are improving. Hopefully this trend continues and they're able to grow even faster while becoming more and more profitable over time until eventually they'll reach the point where they become a profit-making machine. Now that being said, they are clearly not a profit-making machine at this point, seeing as their net loss in the fourth quarter of 2022 was around $28 million, although this is a substantial improvement over last year. The way I kind of think of GBLE is if you think back 10 years ago, there was a huge explosion in e-commerce. You saw e-commerce ads everywhere, you saw Shopify blowing up, and a lot of people made a lot of money. But that was very US and Europe focused. Now we're seeing e-commerce spread into other parts of the world, and companies like GBLE are going to be key to that globalization of e-commerce, which may even cause a second boom in this area of the economy. Now up next, we have one of my favorite companies that I've been investing in for years at this point. That company is Cloudflare, which I currently own 317 shares of at a value of $21,000. And this says I'm only up $500 in the stock, but that's because I invested in Cloudflare, then sold some when it was more expensive, and then bought more when it was even more expensive. And so because of the way Charles Schwab does their calculations, it makes it seem like I've made less money in the stock than I actually did. You'll also notice that Charles Schwab is giving this and pretty much all of these stocks an F or a D rating. As far as I can tell, that's because Charles Schwab uses a value-based approach rather than a growth-based approach, but it doesn't seem to be very good at predicting the outcomes of these kind of companies. As an example, I held one stock, Crowdstrike, for a 300% rise over 2 years, and I think it had an F rating the entire time. So I wouldn't put too much stock in these sort of default indicators. Cloudflare is what I would call a true internet company, and their mission is to make the internet itself work better. They started out by just hosting websites on their CDN services, basically allowing the websites to run on their technology. But then they started protecting those websites with firewalls. Then they realized if we're already hosting all this traffic, let's also try to optimize the experience for good actors instead of just blocking bad actors. From there, they've continued to launch service after service, and they're probably one of the most innovative companies that I invest in. If we just take a look at some of the products they provide, they span everything from applications and performance, security, to even letting customers build and deploy their own cloud applications directly within Cloudflare, something that would have been unheard of a few years ago. Now, Cloudflare is currently sitting at a market cap of $20 billion, which may seem expensive if you look at it in terms of their profitability, considering their net income is still negative at negative $38 million. But if we look at this over time, if we look back one quarter, their net income was negative 45, then negative 42, then negative 63 before that. So numbers are moving in the right direction. At the same time, if we look at their revenue, it grew 53% 1 year ago, then it grew 47% the quarter after that, 41%, and then 37% in their most recent quarter. And Cloudflare expects their revenue to 5x over the next 5 years. So as long as they're able to maintain relatively consistent expenses while growing that revenue, their profitability is going to start happening, and we'll see a massive improvement in their price to earnings ratio. One of the reasons I'm still confident in this company, even though they're losing money on paper, is because in reality, they're not losing money. If we look at their net change in cash in the most recent quarter, they made $50 million, which means they are bringing in cash which they can use to work with, especially if we enter a rough stage in the economy. It just gives them lots of options. So with this company positioned very well for the continued trend toward cloud computing, combined with their very strong growth rate and improving profitability, this is why this is one of my favorite stocks, not to mention the fact that they're just incredibly innovative and always ahead of the curve. Now next up, we have number 5 on my list, which may be a little counterintuitive for some people, but maybe maybe not as surprising as number 7, which is coming up. So number 5, we have Google. And if you haven't heard of this company, you've probably been living under a rock this entire time. Now, a lot of people are aware of Google's consumer-facing services. You obviously have Google Search, you have YouTube, you have Android phones. But one of Google's biggest markets it's trying to enter into is the B2B space, where they sell software to other businesses. And sort of the tip of the spear in this effort is Google Cloud. Now, there's been a ton of hype recently around different technologies. You had blockchain, then you had metaverse. Right now, it seems to be generative AI. But of all the different hype cycles that we've seen recently, this most recent one focused on AI seems to be the most realistic. While a lot of the focus has been on ChatGPT, which is actually owned in part by Microsoft, Google has been ahead of the curve in AI for the last decade. They have their own large language model called Bard, which they let you integrate into all their different services. For example, you can use it with Google Docs or Google Sheets to automate your workflows for you. Imagine if you're a marketer and you have a whole list of emails, you can automate the sending of emails and personalize them to each person using something like Bard. Now, while a lot of researchers do put ChatGPT as slightly superior to Bard, the fact that Bard integrates with Google Docs and the whole Google suite of products makes it incredibly powerful all on its own. And that's even when you don't consider the fact that Google has other AI products that people aren't talking about as much. Computer vision, speech to text, creating voices out of nothing. All of these are different AI technologies that Google has been investing in heavily. And with the new focus and hype on AI, Google is going to be one of the companies that benefits the most from this, especially when they're one of the smaller of the big 3 cloud providers behind Amazon and Microsoft up until now. One indicator that this change is happening right now, Google Cloud had their first profit in the most recent quarter with revenue of $7.5 billion. And they actually made $191 million in profit after losing $700 million last year. So next up, we have one of the most popular stocks for me to talk about on my channel and probably the one that I've made the most money in overall. But before we get to that, let me tell you about a sponsored overviewed company today, paid for by Sideways Frequency. And the stock they're bringing us today is Max Power Mining Corporation, a small over-the-counter stock focused on lithium mining in the US and Canada. While traditionally there hasn't been a large amount of lithium mining in the United States, Max Power Mining Corporation plans to go, quote, all in on lithium. They cite on their website how the Biden administration has announced a bipartisan bill for $3.16 billion in infrastructure, focusing on boosting domestic, US-based battery manufacturing and supply chains, with Canada taking a similarly supportive approach. When you combine this with a growing demand for lithium-ion batteries, which use lithium as a core ingredient from uses like electric cars, mobile phones, and increasingly grid storage for electricity production from things like solar panels. And Max Power Mining Corporation is currently in the strategic planning stages of entering the lithium mining market in the US and Canada. According to the company, crews are currently on the ground near Wilcox, Arizona, hoping the area has similar prospecting qualities to the only currently producing lithium mine in the US, in Clayton Valley, Nevada. This company is also focusing their efforts in an area to the far north of Quebec called Nunavik, an area comparable to the size of the US state of Texas, which has proven reserves of other minerals such as nickel, with 2 operating nickel mines near a deep sea port. The company has acquired land packages in the area, with Max Power's teams planning to test a large pegmatite structure of about 1,000 feet across in the area, where lithium could be found. So thanks to Sideways Frequency for sponsoring that stock overview, and now let's move on to probably my highest performing stock position that I've ever owned. And that company is Crowdstrike. Crowdstrike I currently own 55 shares of at a value of $8,000, and that's off an initial investment of $6,000, so it's only up $2,000 so far. But that's because a few years ago, I actually sold out of Crowdstrike completely at around a 300% profit before waiting it out a few years and then reinvesting this past year. Now, Crowdstrike is an AI-powered security company. Unlike traditional security, which has to look at previous viruses and attacks and try to match that list to new potential threats, Crowdstrike uses AI to scan all potential incoming attacks and determine whether or not they are a threat before they actually impact anyone. One of the biggest places we saw this was in the SolarWinds breach a few years ago, which affected companies like Microsoft and even the US Department of Defense, but was mitigated by Crowdstrike. One of the big trends that we're going to see over the next decade is a continued focus on cybersecurity. We're also seeing a trend toward increased data and AI, and we're seeing an increased trend toward the cloud. Crowdstrike is a cloud-native security company, which differs from a lot of traditional security companies that have built their entire infrastructure to protect on-premise technology. With more and more companies moving to the cloud, or more commonly nowadays just beginning on the cloud to begin with, Crowdstrike becomes their first source for protecting their data. And they are doubtlessly the leaders in this area. And I'm not the only one who thinks that. If we look at the Magic Quadrant for endpoint protection platforms, CrowdStrike ranks the highest for completeness of vision and ranks behind ability to execute only behind Microsoft. And with this company now making almost $3 billion per year in revenue while growing their revenue at 42% year over year, you can see why I'm so excited about this stock. This is a winner in their market, and winners tend to get consolidated into during an economic recession. Plus, they have those three big trends behind them: AI, cybersecurity, and the cloud. Even if CrowdStrike didn't grow at all and just maintain their current market share, the market would grow underneath them and force them to rise even if they were completely inept, and the company is far from inept. Now, next up we have stock number 7, which is kind of a hard pivot over from CrowdStrike. In fact, it's probably the most different from these other companies that I've talked about so far. And once we go through this one, we'll then be getting into stock number 8, which is my single largest investment overall. So stock number 7 on my list is Apple. Everybody knows Apple. They're one of the most successful consumer companies in the entire world, creating Mac, creating iPad, creating iPhone, and more recently launching the Apple Vision Pro. Now, the thing with a company like Apple is so many people are focusing on it that I kind of assume that it's already valued about where it should be. We're probably not going to get Apple on sale, and we're probably not going to overpay for the stock. So the only way to make money in Apple that beats the stock market is to find something about the stock that other people are underestimating. One obvious area to look for this is in AR. Apple has recently introduced their Vision Pro headset, which is their idea of the next generation of computing. Kind of following up with what Meta had done previously with their hard pitch into metaverse and virtual reality, Apple's taking a different twist on this, focusing purely on augmented reality. Now, Apple uses their own terminology for this. They call it spatial computing because they like to invent their own words. But the whole idea of seamlessly blending digital content with a physical space seems really intuitive, and I think is going to be a much easier pill to swallow for people than wearing something like an Oculus headset, which completely blocks off your eyes. Now, Apple usually follows the same sort of pattern with all their different products. The first product they launch is basically a developer kit. No one really buys it except for hardcore developers who are willing to spend a lot of money on a product that doesn't really do anything. But then 1 year or 2 years later, once they've had developers in there and they realize what people are using this for, Apple then iterates and launches their second generation, which they then usually retcon to generation 1, and then they sell it out to everybody in the entire world. Now, is there a chance this product flops? Yes, I think there is. But I think that there's been so much negative pushback against Metaverse, largely due to Facebook's kind of cartoony interpretation of it, that I think people may be underestimating how big of an impact the Apple Vision Pro could have, which is why I think this is an area where a stock that's normally as good as cash could have some upside as well. And finally, we have stock number 8, which is my largest position overall, but stick around until after this to see me reveal my entire stock portfolio for the past year. So my largest position right now is Snowflake, which I own 160 shares of at a value of just under $29,000, and that's basically flat off an initial investment of $29,700. Snowflake is a data company. If you think back to how data used to be handled, you used to write it down on a piece of paper, then it moved into simple spreadsheets on a computer, then databases, then cloud storage. And every time it moved up, there was an order of magnitude improvement in the efficiency of that data. Snowflake has now created the data cloud, which is the next generation of data efficiency. So I've mentioned before that both data and cloud are two large trends that I'm tracking and trying to invest in. The data cloud is kind of the perfect intersection of these two technologies. So companies will put their data onto Snowflake, and rather than having to manage the infrastructure themselves and hire really expensive engineers to set everything up, they can just use Snowflake's platform and all of that is there for them automatically. Snowflake then charges based on usage, so as companies grow and create more data, they pay Snowflake more money for that over time. So why would companies do this? Well, because Snowflake makes them more money than it costs them. Snowflake can do data governance for companies. They can let companies build on top of their platform, meaning they get very entrenched and they're very sticky for their customers. They also let customers monetize the data that they have, and maybe most interestingly, they let companies collaborate with their data. There was a lot of talk about the blockchain and how it would democratize data, where different companies could share data on a common blockchain. Well, companies that are using Snowflake have already been doing this for years, using something called data edges. A data edge is where two companies can share data between each other. So imagine pharmaceutical companies collaborating on a drug. They can all share data on specific areas that they want other companies to have. And guess what? If you're part of that partnership, you're not going to leave Snowflake, because then you lose access to all that data. Now, no one really questions the value of what Snowflake does. Ever since Snowflake IPO'd, it's been an incredibly highly valued company. In some cases, maybe too high. If we look at Snowflake's price to sales ratio, it started out sitting at a price to sales ratio of over 140 before pretty much dropping continuously up until now, sitting currently at a price to sales ratio of 26. Now, don't get me wrong, a price price to sales ratio of 26 is incredibly expensive for any traditional company. Normally a price to earnings ratio you want to see at around 15, and this is just sales, not even bottom line earnings. So if Snowflake is so expensive, why are value investors like Warren Buffett currently investing in this company? Well, if we look at Snowflake's growth rate, they're currently getting close to a $3 billion revenue run rate while growing their revenue at 47% year over year. And this is during a time when companies are starting to cut back on their cloud spending as some of them face some difficulties in the economy. Snowflake is growing at such a rapid rate that they're pretty much outgrowing their valuation. Yes, the price to sales ratio has been dropping over time, but that doesn't mean the price has been dropping. The sales have just been growing so quickly. The big bet with Snowflake is basically this. We hope that the company is going to continue growing long enough or fast enough to outpace the rate at which they are being valued. And as they grow and start to scale, they will then start to experience profitability. It's a bit of a strange way to look at a company because it's almost like investing in a startup, only the startup makes $3 billion a year in revenue. Now, don't get me wrong, this is definitely a risky stock, but there are a few pieces to it that de-risk it slightly. First of all, we know it's positioned really well for the two trends of cloud and data. Second of all, they are free cash flow positive, making $283 million in their most recent quarter. This means that if Snowflake wanted to, they could become profitable at a flick of a switch. They're just choosing not to so that they can instead focus on growing. Having this extra cash also means that if we hit a harder recession, they have money on hand to acquire competitors, buy back stock, or just keep investing in the company. Thirdly, we do know Snowflake has that massive growth rate, and we see it bringing down their price to sales ratio over time. As long as Snowflake can maintain a strong growth rate over the next few years, we should see that price to sales ratio either continue to drop or see the stock price rise to match the growth rate that they're seeing in their revenue. Only time will tell for sure if this company is going to hit it out of the park, but I'm confident enough that I've invested a lot of money into this company. Now, I told you I would show you my full portfolio at the end of the video, so here it is sitting on screen right now. Make sure to subscribe to help us reach our goal of 50,000 subscribers by the end of the year, and I'll see you next time.